Hello students, can I get a confirmation from you all in the chat box if you are able to hear the voice properly? Can I get a confirmation from you all if the voice and the screen is very clear?
Yes,
Thank you
sir,
very
you're
much, Kara.
audible.
Thank you very much, Kara. So students, now today is a very important day because we are going to do the ratio analysis for our company Happy Place, and we are going to compare with our direct competitor who is Gleetil, so that we will get a understanding of the financial health situation of our organization. Now, I have already done the calculations, but don't worry students, I will be explaining how I calculated also, so that you will not have any issues later. Now, initially, I wanted to analyze the growth of the organizations, comparing the previous year with the current year. And once the growth is done, we will effectively focus on the ratios and make sure that is also very clear for you all in your understanding perspective. Okay, students, let's start going through this more in detail. Now, students, if you observe, I will go to the financial statements and you will understand how the growth is done. So initially, students, I just want to guide you with a small information, that is the extract of Gleetil's annual report, because Gleetil is one of our direct competitor, and the market share Gleetil has is effectively 15% comparatively with the other years. So students, now if you observe this very clearly, Gleetil and Happy Place are only major toy retailer in West area that we already know. Gleetil has 150 shops, all of which are located in retail park. That means the same business model only. Gleetil shops are generally larger than Happy Place shops. In simple language, it's a huge one, and more space to set aside for displays of new toys and large items such as outdoor toys including swings and playhouses. Now students, they have 150 stores, and generally the stores are bigger compared with us. And Gleetil is based in West area and it's quoted in the West Arian stock market. Now students, let's come to the application. Now if you see, Happy Place have 120 stores. That is very clear from the analysis. But Gleetil has effectively 150 stores. That means in the size wise, they are bigger than us. Can I get a confirmation from you all if you are clear that Gleetil is a bigger organization compared with us? Because your point of view of thinking is very, very important when you are comparing. So technically speaking, a bigger organization should have a better performance. That is clear. But if we start from the revenue growth, you can obviously see there is an issue. The biggest issue is there is a negative revenue decline for Gleetil stores. But if you see for our stores, it's positive 6.55. Now, I will effectively guide you how the ratios of the growths are done so that it's very easy. This is the basic mathematical thing only. So if I want the growth of revenue growth, like effectively I have done the growth, the change. So I have to consider the numbers 850 and 906. So 906.4, if you subtract 850.7, that is effectively giving you the change. That you divide by 850.7 and multiply by 100, that gives you the growth. Students, can I get a confirmation from you all if you are clear with how the numbers for growth is done? Because there is no practical or a technical formula. It's just a basic common sense. Excellent. Thank you very much, students. So I'm going to move forward with the explanation and how we are going to make the judgments also. Students, in case if I miss anything, you can always tell the points. I'm very happy to accept your point and show it in the classroom. Now you observe this very clearly. The revenue growth is 6.55% for Happy Place. But for Gleetle, it's a 0.11 negative, if I'm not mistaken. So the reason behind this, in my personal observation, I can generally say is Happy Place has invested in the loyalty app. Students, can you remember they have loyalty app, which has around 800,000 downloads also, and direct promotion is given to the consumers. Direct promotion to the consumers. Students, can you remember that? Yes or no? Now, if you observe in 2022, everything has become more personalized. The more personalized attention you give to your users, there is high level of chances that there is high level of sales in the future. So can I get a confirmation in the chat box if you feel this will be one of the key reason why their revenue has grown considerably higher with only 120 stores? That means their app is doing the major direct promotion and making the buyers buy again and again. Are you clear with that point, students? Can I get a confirmation from you all in the chat box? Because we are smaller in size, but we are better in performance. The meaning is we are doing the digital strategy very, very well. I believe that's fine. Now, students, I will continue with the explanation even more. Another factor that would have contributed to the high level of growth effectively can be the merchandising strategies. Students, can you remember the merchandising is a very, very important point here. Merchandising strategies. Example, buying the right toy at the right time. Students, that may be one more thing also, right, students? Because you need to place the order, and specifically action toys or toys which have been affiliated with TV shows or newspaper comics, that generally needs to be acquired on time to the market. That is one factor. I believe everyone is very clear with that sentence also. Further, the organizing of shelves in the stores and the ambience inside the store. Students, can you remember our ambience are vibrant ambience? Children like it, very playful area. Further, the knowledge of the staffs due to the tablet. Can you remember, students, tablet for accessing the product details? Can you remember that point also, students? That is also one more reason this has been better. Further, the staffs have to work only for 8 hours. Therefore, the rota system may be effective in sales, because very, very important in that point also. Further, 48 hours delivery policy. Can you remember that, students? 48-hour delivery policy for online orders. Can you remember that, students? That is also one more major reason we are growing very faster compared with our competitor. Are you observing how we are capturing the growth? Can I get a confirmation from you all in the chat box, students? Because if you have invested in stock markets or anything, generally the stock market or the investment brokers will give you the numbers properly. Success or failure depends on how you know the application of that numbers. Students, are you clear with this? How we are doing better than our competitor students? Can I get a double Y in the chat box if you are convinced with this note, what is mentioned? Because in case if I missed any notes, you can tell me. Don't feel shy. Make sure that you understand and learn. Thank you. Thank you very much, students. Thank you very much. Now, students, coming more in detail to the cost of sales. Now, if you observe, the cost of sales remains the same for both the company. I'll tell you why. Because students, we are not manufacturing. We are buying from manufacturers. So when you are buying from manufacturers, students, that is our major cost. So when you are buying from manufacturers, there will be a listed price, which is generally common to all the sellers in the country. So students, you can't have a huge impact on the cost of sales if I'm not mistaken. So I'll write down here, since the toys are directly purchased from the manufacturers, there cannot be a bigger difference. Since they are being sold at a transparent rate, because you can't go for a bigger rate because of economies of scale. There can be bulk discount, but in this case it's not like that. Is it possible to mention the time loyalty built in the industry? With time in the industry, yeah, that can mention also. That's correct. So students, let's move on to that. Now, the next thing, students, if you observe the gross profit, you see we are having a positive growth, but you see our competitor, effectively, the gross profit has really grown down. Now, students, if you observe this toy industry, the biggest reason why companies make a loss is too much of inventories held and not sold. And sometimes they need to sell at a discount also, in case if they did not sell during the trend period. So I can observe one bigger mistake that would have been done by our competitor is their merchandising would have been poor. They would not have a very strong warehouse system. Can you remember, students, in our warehouse, we have 240 employees who is dedicated to take care of the supply chain management. And we have also made sure an external logistic company is taking care of the delivery of well. So students, I believe this is giving you a better clarity at the moment. So I will write down the points so that it will be very clear for you when you are answering this. So I'll write down here, for Gleetil, the major drawback can be merchandising, since there is a chance that they may have not purchased the right toy portfolio, which may not be at the trend, resulting in, I can specifically write down a very specific sentence, resulting in a drop in the profit, since when the toys are out of the trend, the company needs to provide discount and send off. Example, they can use some lower sales strategy, like, if I'm not mistaken, students, can you remember there was a low sales strategy? This is known as the dump basket, such as dump basket. That would have been also happening, students. Now, students, in contrast, that is our company, I'll write down here. In contrast, Happy Place may have a better, I can specifically mention, supply chain management, since the factory has how much, students? 200 and, sorry, since the warehouse has 240 staffs. Students, I believe that was the main reason we went forward. Now, students, the next one, if I'm not mistaken, I'll take you to the administration expense. Now, if you observe, students, the administration expense has increased in our organization. But if you observe our competitor, their administration cost has effectively gone down. Now, the understanding here that a student should keep in mind is our company has regional managers. Our company has branch managers. Our company has 3 assistant managers. So administration cost is generally higher for us. And I always say, in a business where there is a direct connection with the consumer, it's always better to invest on the employees because they generate the positive reputation. But if you see our competitor, they have done a lot of cost cutting. So effectively, when you reduce your administration cost, it will impact your sales also. Supervision will not be there. Customers may walk into the store and they may go out also. There may be no one to guide them what to buy, what not to buy. So effectively, that will be a problem for them. Students, can I quickly get a confirmation from you all in the chat box if you got that point of view clearly? Because in a service sector where we are involving with people, it is generally not a good decision to send or to reduce the number of headcounts. So I'll write down here, Happy Place has invested well in the staffs. Since we have a regional managers, branch managers, assistant managers, where the administration is well controlled and monitored. Students, I believe this gives you a better point of view. Since we are a sales, or I can say a service enterprise, we need to make sure that we are providing a direct consumer satisfaction, because that is very, very important. Direct consumer satisfaction. Students, I'm going to continue the in contrast sentence, that is our competitor. In contrast, Gleetil may have done some cost cutting. I believe that is very clear. This may increase the inefficiency. This may increase for students in efficiency, where the firm is effectively losing the sales and also the profitability, because that is again a wrong decision done by this company, because certain organization, they do cost cutting on essential items, that is certain environment, so it will affect it. And once again, the biggest blunder that is done by Gleatel is the selling and advertising costs. They have again gone for a cost reduction. I believe you can feel that. And once again, students, toys, children, our direct target audience. If you go for a cost cutting in selling and advertisement, definitely you will not have the customers that is pushing their parents to buy the products for you. So again, a wrong decision done. But students, look at our company. We are now doing promotions in our website. We are also having a mobile application to do promotion as well. So effectively, you have to understand that our company is doing far better. Can I get a Y in the chat box if you understood that again, students? Because this company, the bigger one, is doing a lot of cost cutting, and we are a smaller one, but we are doing a lot of application on growth. We are on a long-term perspective. So I will write down in this case, Happy Playz has invested in apps for loyalty and promotion, and also they use the website for, if I am not mistaken, promotion, which is a digital promotion. I believe that is very, very clear for the classroom. They are using it as a digital promotion tool also. And that gives a better clarity for the students in the class, how it effectively works for you. Now, children, I'll just come to the in contrast sentence. In contrast, Gleatel has made presumptions that they are having, if I'm not mistaken, too much brand visibility due to their scale of operations. But in the reality, they are making a wrong decision. They are making a wrong decision once again. And I believe that is also very clear for you all. Now, students, if you see this operating cost, again, operating profit, once again, it's a negative movement. I will just write down why again a negative movement. If I am not mistaken, the negative movement Y has taken. So that is very clear for the classroom. Gleatel has finally faced the direct effects of their cost cutting in the operation profit. Whereas Happy Playz, observe it very clearly, students, Happy Playz has not got affected by their decisions, since they have spent more on essential expenses. They have spent more on essential expenses. Students, this is very, 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 very important in order to make your understanding clear. Now, this is a real life case study, and many students would have observed many organizations like Pepsi, Coca-Cola. Whatever happens, they will never do cost cutting on selling and advertising. Whatever happens, they spend a lot. But if you observe many local companies, if you have observed, when they grow, they cut down the marketing expenses and admin, which will effectively affect their profitability. Now, the finance cost, if you observe, students, there is a small contradiction. I just want to come here and clarify that. Now, finance cost, I just calculated the growth, if I'm not mistaken. But one thing, students, if you observe, You see one thing, students, we don't have a bank loan. So I will come to that when I'm doing the gearing ratio. No bank loan. Can you observe that, students? There is no bank loan. No bank loan. Can you observe that, students? Can I get a Y in the chat box if you observe that? There is no bank loan and there is no bank OD. That means bank overdraft. Can I get a confirmation, students? If you can quickly give me a Y in the chat box relating to this, so that I will be very clear I am in the right track with my students. Thank you very much, students. I think we are in the right track. We don't have a bank loan. We don't have a bank overdraft. Now, students, I want to ask you a question to make you little think. What is the possibility of having a finance cost? No bank loan, no bank overdraft. What is the possibility of having a finance cost? Because if you observe this lease, what has happened is it's a building lease. And again, students, in this building lease, you would have studied, if I'm not mistaken, there may be a finance cost element on that. But do you think is that the finance cost on lease, or is there anything else that can be the finance cost? That is my question. Now, in this point of view, since you see relatively it is 20.2 and 21.5, one thing we can consider, this is a interest on lease. We can consider it is an interest on what, students? Interest on what, students? Lease. This is one factor to be considered. But other than this, another factor that we can consider, if I am not mistaken, is short-term loan. What is this, students? Short-term loan during off-season. During what, students? Off-season. During off-season. Now, students, if you observe the trend, you see we prepare financial statement for 31st December. 31st December is quarter 4. Quarter 4 is when you have a lot of money. Correct me if I'm wrong, students. Yes or no? Because that is the Christmas time. So when you have a lot of money, you would have effectively paid your short-term loan. Correct no, students, if I'm not mistaken. So I'll write down here Q4 and I will put this as the cash flow. Now the cash flow will go down in somewhere around quarter 3, quarter 2, and suddenly the cash flow will go up in quarter 4. So bank overdraft is needed only during this time, and the bank overdraft is not continued till the financial year end, because on quarter 4 we get the money. Students, are you understanding that explanation? Can I get a confirmation from you all in the chat box if you understood that? Why do we take bank overdraft? We take bank overdraft when there is no money, and in our company we will not have money, not in the end of the year. We will not have money during the year. So that time there may be a finance cost incurred. Are you clear with that, students? During off-season time. That's what there is no bank overdraft given. That's what there is no bank overdraft given. During off-season time, we do not have anything, students. I believe everyone is getting that clarity there. So that is one more point of view. Thank you, students. So I will write down here an observation point. During the off-season, the company may borrow loan. Do you understand that clearly, students? During the off season, the company may borrow loan, maybe at quarter 3, where to satisfy working capital need, that is one thing. But for the toy sector, quarter 4 is the season where they may settle the loan. Students, are you clear with that? Can I get a confirmation from you all in the chat box? Can I get a confirmation from you all in the chat box if you are fine with that? Excellent, excellent. So in this case, if you observe, our borrowing is considerably higher than our competitor. Once again, our working capital needs are little higher. So I'll write down here, Happy Playz pays a higher interest since the working capital needs are generally higher for the company compared with Gleetil. This is the logical reason there. I believe everyone is clear with that example. Now, again, see students, profit before tax, profit for the year, all these things, the common reason why our competitor is having purely a negative answer is they have done a very wrong decision. They have cut down the administration cost, they have cut down the marketing cost, and also students, if you observe, their gross profit margin or the profit sales or all are going down because of poor decision. So I will just write down in this case the same explanation that is there for the operating profit margin. It's a reflection, student. It's a reflection of this. So if you observe on our growth analysis, I can effectively say we are at a very good level of growing at the moment. Our growth is perfectly correct at the moment. So any questions you like to ask, you can ask me. We have successfully completed the growth analysis section. That is completely done. In case if I miss anything, if you feel something that I have missed, please let me know. I will be happy to adjust it in my statement. And if you are completely convinced with the explanations, business-wise, technical-wise, and logical-wise, can I get a confirmation in the chat box so that I can go to the ratio analysis application also, so that it will be very, very easier for you all to understand everything. Thank you very much, students, for your continuous chats. Now, students, moving to the next one, that is the ratio analysis. Now, students, ratio analysis, there are no such rules that this is the correct ratio, this is the correct ratio. No. Always, it's the assumption behind your ratio that will effectively make it is correct or not correct. Now, children, what I will do is I will just guide you with how the ratios are calculated. So the first ratio, if I'm not mistaken, students, I'll just make sure it is clear for you. So I'll write down here ratios. And students, the first one, if I'm not mistaken, is gross profit margin. Students, can I get a Y in the chat box if you can see a whiteboard? If I'm not mistaken, can you see a whiteboard in your screen where I'm writing gross profit margin? Excellent, thank you very much. That is known as the gross profit divided by the sales into 100. The sales into 100. Now, children, understand one thing here, very specific. Now, gross profit that is made in a sale. When you sell a toy, how much is the company making as a profit before you deduct the indirect cost, like the administration, everything. So that is the gross profit margin. So let's go through the calculations, what we have done. Now, as per my calculations, students, you see the gross profit margin is 29.93, 29.08, 27.60, and 31.30. Now, let's go through a direct competition first. 29 here, and students 31 here. I believe you can observe it very clearly. Now, in 2020, our competitor sold it at a higher price, but in 2021, they reduced their price. Can you observe that, students? In 2021, they have reduced their price. Now, one positive thing I can effectively say in this understanding, whatever you can observe in simple language, it is very clear, students, that in this case, like if I'm not mistaken, students, it is very clear that the margins are effectively same. Do you observe what I'm saying, students? The margins are effectively same. Now you observe it very clearly, students, not a big difference, 1% difference or maximum 2% difference. So in the business industry point of view, there is no price war. Price war is not there. That we call is as a Wolfgang industry. A Wolfgang industry where the competitors are very much united. When the competitors are very much united, they will be able to have a price control within themselves so that in the market, they will be very strong enough to move forward. Now, students, one thing I have to observe with Gleetil, they would have had a very poor merchandising in 2020. They need to give discounts because they would have bought toys and they would have not sold it during the trend. So effectively, they have to reduce it by giving discounts, and that is the reason. So I will start with the industry first. The gross profit margins are generally same. Students, correct? No, students, same or a slight variation. This is called the Wolfgang industry strategy. Wolfgang industry strategy. So if you try to reduce your price, it will be a bigger blunder later on. Students, I believe this is extremely clear for you all. So what I will move forward is, for Gleetil, they have reduced the gross profit margin since there can be excess stocks in the previous year due to poor, again observe it very clearly, due to poor merchandising. Due to poor what, students? Merchandising. Students, can I quickly get a confirmation from you all in the chat box if you understood that verb very clearly, students? There can be excess stocks in the previous year due to what, students? Poor merchandising. Can I get a confirmation from that, students, if possible? Yes or no? Yeah, thank you very much, students. Thank you very much. Now, students, what I will do forward, it will be even more easier. And I will just continue the sentence also. So let's go forward. So I'll write down here for Happy Playz. For Happy Playz, they have increased the margins slightly due to better merchandising, because merchandising is very, very important. You need to buy the toys in advance from the manufacturers, and certain toys are limited editions. So when there is a limited edition toy in the market, the company has the probability to sell more of it. So I believe that is very clear. Now, students, coming to the operating profit margin. Now, if you see operating profit margin, again, the logic is very simple. So I'll just write it down for you all. Operating profit margin. It's again the same idea. Margin means we take it on the sales. So operating profit, that is profit after you subtract the operational cost, administration and distribution, whatever that is left when you make a sale. Now, let's see in this case, in the operational profit, technically the leader is Gleetil. Technically the leader is Gleetil. I believe everyone is very clear. In the operating profit margin, technically the leader is Gleetil. Can I get a confirmation from you all in the chat box? And even students, profit for the year margin, if you observe, leader is Gleetil. Gleetil is dominating that. Now, as a layman, people will say Gleetil has better profit, invest in Gleetil. But as a financial students, you need to understand, although they have made a good profitability margin in operations and profit for the year compared with us, You look at their growth is extremely poor, right, students? Do you feel that? Their growth is extremely poor. The main reason their growth is very poor in this case is they have achieved this not by sustainable method, they have achieved this by shortcuts. The shortcuts that they employed was cost cutting the administration cost and cost cutting the selling and distribution cost. So students, you need to have that financial accountant knowledge in order to come to that. So just to make it one more clear, students, the net profit margin, same logic, net profit divided by the sales multiplied by 100, same logic only. But I am clubbing these two together so that your understanding will be even more clearer. So I'll write down a very basic sentence technically, and then I will convert that sentence into more logical application for your understanding. In the technical aspect, the operational profit is really better for gletal. Correct, no, students? It's really better for gletal. But in business sense, they have achieved this growth by what, students? Cost cutting essential expenses such as administration and what, students, if I'm not mistaken, administration and selling and distribution, students, marketing, promotions they have done. Therefore the growth is affected. The growth is affected. I believe everyone is clear. The growth is completely affected. Very, very transparent and very, 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 very clear. The growth is affected. This means still happy Playz is better in the going concern. Look at the verb I am using. In the going concern compared with lower ratio, compared with lower profit ratio. I believe everyone got that understanding clearly. Can I get a Y in the chat box, students, if you got that understanding clearly? Because that is very, very, very important. Fundamentally, that is important for you to get that understanding clearly. Excellent. Thank you, students, for your effective engagement. So I believe that has given a better understanding and ideology for you all, how this has got affected. Thank you. Now, again, students, ROCE and ROI, initially I will explain the formula of my assumption. And then, students, I will come to the technical application of what is done. So the three ratios, what is above is known as the profitability ratios. Now I will come to the other point of view so that it will be very clear and easy for you to understand. One is known as ROCE, return on capital employed. Again, we take the operating profit. Once again, I'll write it down. We take the operating profit. Okay, but we divide it by, I'll write down the technical aspect and then I'll tell what is known as. The denominator comprises of the following, students. It comprises of two things. One is known as, students, total equity, because capital, equity capital we generally say, total equity, and students, long-term borrowing, Now, in this case, there is a special circumstances, because in this case, we don't have a loan, but we have a lease. And I have to consider that lease in the denominator. I have taken the lease in the denominator. I'll tell you why. Without lease, it will affect your ROC. I'll tell you why. Because you need to have a property in order to have operations. Because operating profit we are taking, property is essential. So I can say that lease is a part of capital employed because it is a part of the essential requirement for the operation. Students, can I get a Y in the chat box if you understood why I took lease as a denominator for long-term borrowing. Can I get a confirmation from you all? It's a common sense application, students, using the business knowledge. Using the business knowledge. Technically speaking, no, but practically speaking, you need to make sure there is some concern given on the industry perception also. Now, children, coming to the next one, I am going to focus on ROI. ROI in simple language is known as return on investment. How do we calculate? Very simple. That is known as net profit. That is known as net profit in simple language. Now, net profit, students, I am going to divide it by investment. Investment in this case is a very, very direct investment. Who is the investment? That is the investment in simple language given by the shareholders only. So I will just write down here total equity. Total what, students? Equity. That is the ROI in this case into 100. So it will give you the ROI for the shareholders, and this is giving you the total return for any investors, the debt capital investors and also the interest rate investors. So students, can I get a confirmation from you all in the chat box if you got the equations clearly? And specifically remember one thing, students, I have taken lease as a denominator. I have taken lease as a denominator. Excellent. Thank you, students. Now, children, coming down here. Now, if you see, we have 24.07, 20.57. But again, you see here, the ROCE for this organization is anyway technically better than our organization. I believe that the students are very clear. Technically, they are leading. But once again, students, they have done this ROCE, the operational profit in simple language. I will just take you here. If you see our competitor Gleetil, so I'll just write down Gleetil with the blue color. So Gleetil, if you observe, students, their operating profit margin has increased. And that may be one reason the ROCE of their company is greater than our one. But again, the reason for the increase you need to always justify. The reason for the increase is they have taken out the administration cost and they have also reduced the selling and distribution cost. So students, this is the rationale for this. They have not taken it successfully due to their growth in the market share or the growth in the sales. It is due to the reduction in this. But the question of doubt again arises, is this sustainable? The question of doubt again arises, is this sustainable? Technically speaking, it's a very, very judgmental question and it's not sustainable in that perspective. Students, can I get a confirmation from you all in the chat box if you are clear with that, how they got the operational profit better than us? That is the major point of view. And fraud, financial frauds in the stock markets generally take place when the majority of the investors are only following the ratios without even knowing the rationale behind the ratios. Now, students, I am going to continue this sentence in more detail. So I'll write down here. The ROCE is technically better, for, if I'm not mistaken, for Gleetil, our competitor. But the main reason for this can be, once again, the operational profit increase due to what, students, if I'm not mistaken, the operational profit increase due to the increase in the I can say operating profit increase due to decrease in the admin and selling and distribution cost. This may not be sustainable. Since in the market there is other competitors like browser shop. Correct, no, students? Now if you are like this, browser shop is going very far, and if I'm not mistaken, we have another person who is known as the cover catalog. Students, I believe this gives you a better clarity at the moment. And then students, just to make it even easier for you to understand, finally, we need to understand. Finally, we need to understand that that Happy Place has a decent ROCE, has a decent ROCE. So that is the ultimate understanding there. So I believe everyone is effectively clear with this point of view, and there is no issue with that. Thank you, students. Now, children, I'm coming for the ROI. Now, ROI, you see, there is a huge drop. Again, you see from 36.9, the drop is there if you observe it very clearly. But you see here, if you observe it very clearly, our ROI is better than ROC. There is something wrong. Can someone tell me what is the wrong factor? Because if you see ROC and ROI should be generally, if you see it's on net profit and the investment. Now, if you observe in these cases, if you observe our ROI is generally high, I'll tell you why also. Now, if you observe here, students, very transparent, you can see our company's retained earnings. We made a profit of 77.1. Correct, no, students? Profit for the year was 77.1. But if you observe, students, the dividend we paid was 74.2. So there is almost a 90% payout ratio. Are you understanding what I'm saying, students? So when the retained earnings goes down, the equity goes down. Agree or not agree, students? Are you understanding? When you pay dividend, the equity goes down. Are you getting that clarity there, students? Can I get a confirmation from you all in the chat box? This is a form of manipulation, an adjustment you can make to make your ROI go up. This is all basic knowledge. Now, students, I will come back to here. So when the equity goes down, now I'll give you a scenario. Net profit is 1,000 and equity is 200. Okay, equity is 200, or let's make it equity is 2,000. Equity is 2,000. Then if you observe into 100, you will get ROI 50%. Now net profit is still 1,000, students, but your, in simple language, you have somewhat reduced your equity by paying dividends, something like that. Now it's 500. So if you observe this, it will be effectively 200%. So what happens is there is no change in your business performance. It is remaining same, but you have done a small adjustment to your denominator, which is your equity, using the tool of paying dividend. And then another technique that companies use to manipulate is revaluation. Students, there is something called revaluation. Now, revaluation is again a manipulation tool that is used to adjust the ROI. So students, can I get a confirmation from you all in the chat box if you are clear with how the ROI works, students? Can I get a confirmation from you all in the chat box? Because that is very important, very important that you are getting that understanding. Excellent. Thank you very much, students. Now, that is one reason the ROI has gone up. And let's see our competitor. So if you observe our competitor in simple language, let's see how. Now, if you see, they have made a profit for the year of 139.4, of which they have effectively paid a dividend of 48 only. So students, comparatively, they are paying almost a lesser, I can say, a dividend payout compared with us. So here we are paying a very high dividend payout. That calculation I have done also. I will come to that, but just remember one thing. So I'll write down here, the ROI is good in both companies, but for Happy Place, there is a growth not due to the performance, not due to a student's performance. It can be due to higher dividend payment. Now that is again a question mark. We need to identify why did they pay such a high dividend when the competition is very high, because you need a lot of money to reinvest to run this business successfully. specifically competing with Curve Catalog and also Browser Shop. So why there is high dividend? That can be a potential unseen issue also, students. We are a listed company and we have to ask ourselves why there is a higher dividend. That is one factor. Now, if you see interest, as I already explained to you, students, interest, we are not actually taken a bigger loan or anything. It is during the seasonal demand is over. The off-season time, we will take it. So, students, I'm going to write down a short note. It will be very clear for you all to understand. So, can I write down here interest cover? The first thing I'm going to write down here is what, students? Interest cover. Now, interest cover, if I'm writing down, students, it's very simple. You take the profit before interest. You take the profit before interest, and what you do, students, you divide that by the interest cost or the finance cost. Now, in this case, let's assume the profit before interest is 1,000 and the interest cost is 200. That means it is 5 times. That means the company has enough money to pay you, so the risk is very less. That is the understanding of that. Now, students, coming into the detailed application, you see the interest cover looks very stable in both the companies. So I don't think there is an issue with that. So I'll write down here, the interest cover looks stable for both enterprise. Therefore, there is no issues. So students, I believe that is also very, very clear for you at the moment. So students, gearing. Now I will explain the gearing and then I will tell you why I assumed it to be 0. So I'll write down here gearing ratio, students. Now gearing ratio, the preferred one is this. This is a percentage. Okay, although we say we can show it in percentage. You take the debt. That can be in the form of bank loan or a long-term liability. So I'll mention here bank loan. Okay. And then you divide it by the debt you have taken, plus the equity. Because students, the total debt and equity gives you the total capital in the company, of which how many percentage is debt. That is one. Example, let's assume the debt in this case is 200. So 200 plus 800. The total finance in the organization is 1,000, and of which 200 is effectively a loan. So in this case, 20% is the gearing ratio. Students, can I get a confirmation in the chat box if you are clear with that? So the second one, if I'm not mistaken, the alternative one, we call it as the debt divided by the equity. The debt divided by the equity, it's a ratio. Now, the same example, debt is 200, equity is 800. So if I'm not mistaken, 1:4. The meaning is your equity size is 4 and your debt size is just 1. So if you observe, your equity is powerful. Your equity is more proportion than your debt. Now, students, I believe it is very clear at the moment. So the next thing, students, if I am not mistaken, what we have to do is another point of view in simple language. Loan and lease. There needs to be a comparison. Now I have put it is 0. So I will do a small comparison and show it to you. Now, children, you understand very clearly, loan is generally cash. Correct, no, students? Loan is generally what, students? Cash. Makes sense or doesn't make sense? Of course, makes sense. Loan is cash. Correct. Now, cash is actually a obligation. It's actually a financial what, students? Obligation. It's a cash. It's a financial obligation. You need to anyway pay. It's a law also, by the law also, if it is a limited liability company or a listed company. But a lease, students, is that cash or property? It's property or asset. Correct me if I'm wrong. It's not cash. It's property or what, students? It's property or what, students? Asset. Is this a financial obligation or operational obligation? It's an operational obligation. That means if you do not pay the lease, they will not come and ask money from you. They will take their premises back. Are you clear with what I'm saying there, students? So in this case, my observation here is we are not having a financial gearing. We may have an operational gearing, not financial gearing. Students, are you understanding what I'm saying there, students? Are you clear with that point of view? Why I did not take the lease in this particular situation? Because lease is not a financial commitment. It is something different. So can I get a confirmation from you all in the chat box if you are fine with that, students? It's a very, very important and an essential point. Can I get a confirmation from you all in the chat box? Excellent. Thank you very much, students. Thank you very much, students, because that is the knowledge important. Little bit confusing also. Little bit confusing also. But remember one thing, if you have a car and if you have a bank loan, if you don't pay, you will be taken, your credit rating goes down. But you have a car which is leased, you don't pay, they will take back the car. You need to understand the logical idea behind that. Excellent. So students, I will come to the application so that it will be very easier for you all to understand. In the case of both the enterprise, in the case of both the enterprise, there is no financial obligation. There is no, what, students? Financial obligation of a bank loan, but there is a, I can say, lease, which is an operational commitment, Students, I believe everyone is very, very clear with that point. Now, children, coming to the next one, you have to understand this really. There is two ratios called the current ratio and the quick ratio. I'll quickly come to that and I'll just guide you what is those two are, so that it will be very, very easier for you all to understand what are those two are. Now, children, if you observe the basic thing of current ratio, it is very simple. The current asset of an enterprise, you take the current asset, and then what you need to do, students, you take it, the current asset, and deduct the current liability. Are you understanding that? Divide it by the current liability. So that gives you the efficiency. And then there is something called the quick ratio, which is a situation where you may have inventory. So you take the current asset and you remove the inventory, then you get the liquid assets, the assets which are purely cash basis, and then you divide it by the current liability. So students, the technical knowledge, it is 2:1. That means you need to have 2 times assets for your liability. And in the quick ratio, immediately if you want to pay something, you need to at least have 1:1. Your liabilities and your current assets should be equal, because students, in case if there is a commitment to repay, you can pay it easier. That's what they are stating. Now, if you go with that technical logic, you observe here, we are very poor. Both the companies are very, very poor with the technical logic. Correct, no, students? Technically, I think both the companies have an, I can say, liquidity issue. Technically, both the company has a liquidity issue. Students, I believe that is very, very clear for you. Technically, both the company has what, students? A liquidity issue. I believe everyone is very, very clear with that point of view. Technically, both the company has a liquidity issue. Now, students, I'll come to this more technically and logically. You understand. Now, you see, students, current asset, current liability. Now, you observe current asset, inventory, trade receivable, bank, 1460, 132. That is clear, not an issue. But if you look at the technical current liability, you see here, we have taken the lease, we have taken the tax. Now, that is the main reason it looks less. Now, technically, you see 146, you divide it only by the trade payable, which is 123.1. Frankly speaking, we are good, somewhat good. But the problem in this case is the lease liability. Now, students, if you observe trade payables, it is effectively, I can say, a working capital consideration. Lease liability and tax is not working capital. Lease liability is for operation, and tax, if I'm not mistaken, is a legal commitment. So technically, if you are speaking, the main reason why we are having very lower range of this current ratio and the quick ratio is mainly because of the lease liabilities and the tax liability. So students, can I get a Y in the chat box if you got that point of view clearly? So effectively, we are not having any problems, because in this technical perspective, it looks like a problem. Only reason is we are considered lease and tax. So I will make a note about that so that it will be very clear for you all. Generally, the lease and tax is included. Tax is included in the current liability. This is the main reason for lower range. For lower range. But in practical terms, they are fine. Students, can I get a confirmation from you all in the chat box? Because you need to understand lease and, if I'm not mistaken, tax. So can I highlight this lease and tax so that it is very, very clear for you all? Thank you very much, students. Thank you very much, students. Now, coming to the next one, students, inventory, receivable days, and the cash cycle. That is cash cycle, very easy. That is inventory days plus receivable days is cash cycle. 33 plus 8 is 41, 35 plus 8 is 43, 27 plus 12 is 39, and 26 plus 10 is 36. I think this is only cash cycle. The time your money is in the form of inventory and the receivable. So initially your money is tied up in the inventory, then it goes on credit period, and effectively it takes 41 days to receive financial capital or your money back. So students, I'll just put this section as a green color section so that it is very, very clear for you all. Can I get a confirmation from you all if you understood what is cash cycle? The time taken your money to come back to your company, that is only cash cycle. Cash cycle. Excellent. Thank you, students. Now, if you see inventory, I just want to guide you. So how the working capital management is done. What was the assumption? So I have taken the inventory, that means only closing inventory. I did not take average. Closing inventory, and I divided by the cost of sales and multiplied by 365 days. 365 days. Similarly, children, for the trade receivables, I took the closing trade receivables and I divided by the sales multiplied by 365 days. And the final one, students, if I'm not mistaken, that is the trade payable, again closing payable balance in the balance sheet or the statement of financial position, and the cost of sales. I'll guide you here because we don't have any credit sales information. So in a situation when there is no credit sales, take the sales, and even the cost of sales may have included the purchases. So that's how we have concluded. So can I get a confirmation if you are fine with the working capital ratio assumptions? Because it's a comparison between 2 years. It's a comparison between 2 years. If I had taken average, it will not be a comparison between 2 years. It will be comparison in between 2 years. That means both in average. So I am going through this. So inventory days 33, 35, but here it is 27 and 26. So here, what's the ideology is their inventories are going faster, but our one is a little bit slow. And the good reason why our one is slow is, can you all remember, students, in this case study, they clearly told that we generally buy the limited edition inventories or the toys well in advance from the television producers or the movie producers and stock it. And when they launch the movie, we effectively release it to the market. So in this, we can't say that we are having a bad inventory policy. We can say our inventory policies are a little bit higher than the other one. The main reason is we generally what students stock like limited edition toys before the launch. So I'll write down here, generally, Happy Playz stocks the toys which are limited therefore they can sell when the movie is launched. This is done on a precautionary method. That's the reason, students, our ratios are very, very high. If you see, our growth is very, very high because of this. So students, that is one more reason behind that. I can say good merchandising. Students, can I quickly get a confirmation from you all in the chat box if you are clear with that inventory perspective, because that is fundamentally important for the students to understand how it works out. Now, students, the receivable days 8, 8, 12, and 10 days. Now, the logical idea you need to think practically, why we have 8, 8, 12 days? Our customers pay on time. How can this have 8 days? I'll tell you very clearly. Students, can you remember when you buy anything from a retail store, they will effectively give you a 7 days time to, I can say, replace the goods. Can you remember, students? Replacement time is 7 days when you buy something from a supermarket or anything. You can show the bill and you can change the product. Can I get a Y in the chat box if you understood that? In this, we don't have any credit customers, but the idea behind this is we are giving them a return basis period of 7 times. That is the idea here. So I'll write down here, we don't have credit sales, but in the general retail sector, generally customers are provided 8 to 10 days return policy. They have that, students, you would have experienced that in your purchasing shopping industries. Cash cycle, if you generally see, moderate. I can say generally the cash cycle looks moderate, but it can't be accurate. I'll tell you why. It can't be accurate. What is the reason it can't be accurate? Since it ignores seasonal demand. Can you remember, students? It ignores seasonal demand. Now, students, can you remember these numbers are excluding seasonal demand? Because these numbers are wrong, actually, if you think in the businessman point of view. Because, students, you see, there may be time, sometimes in the month of June, July, where our gas cycle will be extremely longer. Correct, no, students, if I'm not mistaken. So it ignores the seasonal demand. Can I get a confirmation from you if you understood that these numbers are correct mathematically, but in the business sense, it is effectively ignoring the seasonal demand? Excellent. Thank you very much, students. Now, children, coming to the next one, payables, if you see, our customers are paying little later, but we are paying little earlier. The positive thing of paying earlier is high preference. Because, students, a manufacturer will always prefer the company which pays earlier. You get what I'm saying, students? Now, if you are paying late, manufacturers may not like you. Are you understanding that logical application, students? Can I get a confirmation? That means if there is a new product launch, they will always come to you first, because you will be paying the manufacturers earlier than the rest of the marketplace. So I'll just write down here one more point of view. The payable days may be less, but in practical terms, this is generally better, since when you pay early, the manufacturers may prefer you first and provide the limited edition toys first. Correct, no students? There are limited edition toys first. Limited edition toys first. I believe it is very clear there. So working capital cycle, 3 days and 1 day, I think that can be easily managed. And here they are having 7 days excess cash. Observe 39 days they receive cash, but they pay late. They have money, but they don't pay on time. We don't have money, but we still manage to pay our payables on time. So effectively, I can generally say, compared with Gleatil, we have a better supplier relationship. Students, I believe that is a very clear point. And the last one, the dividend payout, this calculation 96 and 35, we have paid a very high dividend, which is very high dividend, which can be an unseen issue, Are you understanding that point of view, students? Since we have not received the reason behind it, because we are paying very high dividend compared with our competitor Gleatil. Students, a very strong analysis has been done, and I believe you have very clear with what happening now. We are doing very well. Our company is doing very well. In our initial reading and judgment, I can say Gleatil is not our major target. Our major target is browser shop and cover catalog, because students, they don't have any physical stores, but still they have 15% market share and 17% market share. So effectively, their financial statements will have more cash flow. Overheads are very less for a technically, I can say, a virtual business. Students, any question and answers you have, you can ask me. I will just call your names. You can ask your doubts. If you are completely fine, you can put Y in the chat box. Douglas, any questions? Karen, any questions? Hinmin, any questions? Nicholas, any questions? Dr. Sharmin, any question? And Dr. Shenaz, any questions?
The dividend payout ratio for every place, it's a bit riskier. So I think they are paying too much dividend. So
of course. That is what our discussion is. We are paying too much of dividend, considering the competition in our external environment. Because when we pay too much of dividend, we may need also finance to compete in the market. So that is the biggest challenge that we are facing. It's very risky to pay. And the clientele effect, what happens is next year also the shareholders may be expecting, the expectation goes up. So you may have a bigger challenge in negotiating with the shareholders also on how to reduce the dividend payouts.
They don't have sufficient money. If they don't have sufficient money, then what will they do? So dividend equalization fund need to be created by giving less dividend or for further investment in future. So they need to
correct. That is the argument. That is what I'm saying. They will have a huge problem with the fund, and funds are important not only to pay the dividend, also to make sure you compete in the industry as well. Because we need to take care of the market share, overhead, everything. So what you are saying is perfectly correct. And in case if they don't have money, the only solution can be bonus issues. You need to give more shares to the existing shareholders free of charge. But when you give bonus issues, there is a negative consequences. It's like the increasing, like the money supply, like when the shares are less, only the share will be solid, strong. But when the shares are more in the market, the value again will reduce in the long run. Like you print more money, the value of the money reduces. Similar to that, when you give bonus share, same thing happens in the long run, not immediately. Is that clear?
Yes.
Thank you. Thank you. So students, I believe we have done a wonderful analysis. So I will teach you the writing styles most probably in the next week class. So you can take a holiday and you can read through the examiners articles, past papers during these days. And if you have anything, you can directly reach me out. So thank you very much for your wonderful time and wishing you all a very prosperous new year. So take care, students.
Happy New Year, sir.
Thank you. Thank you. So take care, students. All the best.